Hi there, and welcome to another Stock Insights video on Stock Market Palantir. Make sure to hit the subscribe button and drop any comments. Now, let's go for the analysis.
$13.90. As of this morning, mid-January 2026, Sentinel-1 is trading at roughly $13.90. We are hovering critically, dangerously close to the 52-week low of $13.86. If you look at the year-to-date performance just for the first couple of weeks of 2026, we're already down about 8.24%. But the price itself is only half the story. The volume dynamics are telling us something even more specific and arguably more terrifying about the psychology of this market.
It's the consistency of the selling that stands out to me. It's just relentless.
Precisely. We are seeing average daily volume between 5.8 and 6.6 million shares. But look at the distribution. We have a clear distribution days pattern. For those listening who watch the tape, this is when the stock drops on high volume, like January 16th, where volume spiked to 11.36 million shares. But on the days the stock tries to rally, volume it contracts significantly. The buyers aren't showing up with any conviction, while the sellers are just hitting the bid with force.
It is a textbook capitulation trade. The market is screaming that it wants out. But the central tension here, and the reason we're locking horns today, is the disconnect between that abysmal price action and the headline numbers. You have a company that just crossed the holy grail of sauce metrics, $1 billion in annual recurring revenue, or ARR. They grew revenue 23% year over year in their fiscal Q3. And yet the stock has been absolutely decimated, down over 36% in the last 12 months.
And that is where I plant my flag. I believe we are looking at a massive market dislocation. Sentinel-1 right now is a deep value opportunity hiding in plain sight. I would argue this valuation compression is being driven by artificial price suppression and anomalous market structure mechanics, specifically in the dark pools, rather than a fundamental collapse of the business. The market is emotional. The math is not.
Look, I appreciate the optimism, I really do, but I look at the same chart and I don't see a dislocation. I see a rational correction. Cheap does not mean good. I believe the market is correctly pricing a fallen angel. You have deteriorating governance. You have widening gap losses in a high interest rate environment where capital is expensive. And frankly, you have a competitive landscape where CrowdStrike has effectively won the war. This isn't a mistake by the market. It's a rational response to a broken investment thesis.
I understand why the sentiment leads you there, but let's strip away the emotion and just look at the valuation relative to the asset. We are looking at a company trading at approximately 4.5 times sales. For a software company with 79% gross margins and 23% top-line growth, that is distressed asset territory. That is a multiple usually reserved for hardware companies or, dying legacy tech, not a growing cybersecurity platform. This pricing implies bankruptcy is on the table, which it's absurd given they have $1.1 billion in cash on the balance sheet. My position is that the market has swung the pendulum too far. The AI native pivot they are executing, specifically with the acquisitions of Observo AI and Prompt Security, sets them up for the next wave of cybersecurity. They are moving beyond the commoditized endpoint market. The current price is a gift for anyone willing to look past the fear.
That is a compelling narrative if we were back in 2021, but let's look at the profitability paradox. You mentioned those 79% gross margins, but we need to be very clear for the audience, that is non-GAAP. That ignores stock-based compensation. When you look at the actual bottom line, the GAAP net loss, it widened to $340.5 million year to date. In a zero interest rate world, you could get away with burning cash to grow. In 2026, that is toxic. And it's not just the financials. It's a crisis of confidence. The CFO is leaving in the middle of January. That is terrible timing. And the CEO, Tomar Weingarten, sold roughly 125,000 shares in December near the lows. Why would you sell at $15.09 if you believe the stock is worth $30? My view is that the winner takes most. Dynamic has, it's already solidified around CrowdStrike, and Sentinel-1 is merely a source of funds for investors rotating into quality.
Let's dig right into that valuation gap, because that is the crux of the bull case. You cannot ignore the spread. SentinelOne is at 4.5 times ARR. CrowdStrike is trading at roughly 22 times ARR. Even Palo Alto Networks and Zscaler are sitting at 13 to 14 times. We are talking about an 80% discount to the market leader. I'm not saying SentinelOne is CrowdStrike, but does it deserve to trade at a fraction of the multiple? Even if we just see a mean reversion to, say, 8 times sales, which is still half of Zscaler's multiple, you're looking at a stock price of $25 to $30. The risk reward is completely asymmetric. You're paying pennies for growth.
I think you're falling into the value trap fallacy there. You're comparing apples to oranges. That premium for CrowdStrike exists for a very specific reason: free cash flow. CrowdStrike is a platform generating massive cash. They are a money-printing machine. SentinelOne is a point solution that is still burning cash to keep the lights on. And that 23% growth you cited, context matters. That is a significant deceleration. They used to grow at 50% or more. The market sees that the low-hanging fruit is gone. Customer acquisition costs are rising. And I'm not alone in this assessment. Look at the analyst activity in just the first 2 weeks of January 2026. You had capitulation across the board. Piper Sandler cut their target to 17, Citi cut to 18, UBS downgraded them to hold. The smart money on the street is throwing in the towel.
That's an interesting point, though. I interpret that data very differently. When analysts cut price targets to $17 or $18 while the stock is trading at $13.90, that is actually a bullish contrarian signal. Think about it. The stock is trading below the most bearish targets on the street. That is a classic oversold condition. The analysts are chasing the price down to protect their reputations, but the market has already overshot to the downside. The sentiment is so washed out that any positive news creates a massive re-rating event. It's a compressed spring.
Or the analysts are just slow to catch up to the reality that the business model is broken. But you mentioned earlier that you think this price action is artificial. You hinted at market structure.
About the dark pools. For the listeners, dark pools are private exchanges where institutional investors trade large blocks of shares away from the public eye. I've been analyzing the off-exchange data for SentinelOne, and there is a smoking gun here. The off-exchange short volume ratio is currently sitting at, get this, 67.39%.
Wow, that's unusually high.
It's not just high, it is an extreme outlier. The normal range for a stock like this is, 44 to 50%. When you see 67% of the volume happening off-exchange and heavily skewed towards shorting, it suggests that price discovery is being obfuscated. Essentially, institutional sell orders are likely being routed to lit markets, the public stock exchanges, to suppress the displayed price, while buying and covering happens in the dark. It creates a synthetic ceiling on the stock.
I have to push back on let's call it the conspiracy angle. I view that 67% number differently. To me, that looks like sophisticated institutional hedging, not manipulation. You have large funds that might hold a long position in SentinelOne, and they are boxing it.
Explain boxing for the listeners.
Sure. Boxing is when you hold the stock, but you open a short position against your own holdings, often in the dark pools, to neutralize your exposure. You do this to manage risk without actually selling the shares and triggering a taxable event. Given the volatility we've seen, these funds are terrified of the downside, so they are hedging aggressively. It's not necessarily nefarious, it's just risk management in a falling market.
But look at the liquidity crisis that strategy creates. The days to cover metric has risen to between 3.4 and 4.2 days. This measures how many days of normal trading volume it would take for all the short sellers to buy back their shares. Because the volume is so low on up days, liquidity is drying up. If we get one piece of good news, a buyout rumor, a beat on earnings, those shorts are trapped. They would need 4 full days of buying to exit their positions. With 67% of the volume in the dark, the exit door is very, very small. This isn't just a trade, it's a powder keg waiting for a match.
A powder keg or a falling knife. You need a catalyst to trigger a squeeze, and right now the catalysts are all negative. Let's talk about the governance issues again, because I think you brushed past them too quickly. The CFO departure in mid-January is a massive red flag. When a CFO leaves right before the fiscal year-end close, it raises serious questions about financial controls. Is there a kitchen-sinking quarter coming?
Kitchen sinking meaning they dump all the bad news at once to lower the bar for the future?
Exactly. Are they about to restate earnings? Did they find a hole in the balance sheet? Investors hate uncertainty, and this is uncertainty central.
It is a risk. I acknowledge that. Executive transitions are never comfortable. But I'm more interested in the board refresh. They just brought in Mark J. Bernicia, the CEO of OpenText. That is a serious operator. You don't bring in a heavy hitter like that if you were planning to fail. It signals a shift toward operational maturity, or perhaps preparing the company for a strategic sale. OpenText is known for acquisitions and efficiency. This could be the adult supervision the company needs. And regarding the CEO selling, diversification is standard for founders.
Selling at a 52-week low is not standard diversification. It's a signal. If Tomer Weingarten thought the company was about to turn the corner and double in value, he wouldn't be selling at $15. He effectively capped the stock. He told the market, I am willing to sell here. Why should I buy at $14 if the CEO is selling at $15? It creates a psychological barrier for any new investor.
Because he's looking at his personal portfolio concentration. And we are looking at the enterprise value. Founders have different liquidity needs than institutional investors. But let's pivot to the product because that is where the real value lies. The market thinks Sentinel-1 is just an endpoint detection and response, or EDR company. That is the old narrative. The acquisition of Observo AI for $225 million is a game changer that the market hasn't priced in yet.
It looked like a desperate pivot to me. Buying revenue because organic growth is slowing?
I strongly disagree. It moves them from catching viruses to data observability and cost optimization. Let me explain why this matters. Observo AI is a telemetry pipeline. It filters and compresses security logs before they go into expensive SIEMs, security information and event management systems like Splunk. Right now, companies are drowning in data fees. Sentinel-1 can now go to a CISO and say, not only will we secure your endpoints, but we will cut your Splunk data bill by 30 or 40%. In this macro environment, cost savings is the easiest sell in the world. It funds the purchase of the security product.
That sounds good on a slide deck.
And then you add prompt security, which secures generative AI workflows. They are protecting against large language model injections and data leakage. They are building the infrastructure for the next 5 years, not fighting the last war against CrowdStrike.
That is the bull case in a nutshell. Betting on the next thing because the current thing is stalling. EDR is commoditized. CrowdStrike won that battle. Now Sentinel-1 is trying to become a data company? That is a hard pivot to execute while you are bleeding cash. You are asking investors to fund a transformation story when they signed up for a growth story. And speaking of the macro environment, there's one more data point we have to address, the polymarket correlation.
Right, the prediction markets. We received a specific request to look at this.
It's vital context. If you look at polymarket.com right now, the prediction markets are pricing in a very high probability of U.S. cyber attacks and conflict involving Iran and Israel in early 2026. Normally, cyber stocks have a defense premium. When war risk goes up, cyber stocks go up. It's a defensive hedge.
Correct. It's usually a direct correlation.
But that is exactly my point. Sentinel-1 is decoupling from that reality. We are seeing a negative correlation. The world is getting more dangerous. The cyber war thesis is front and center on Polymarket, and yet Sentinel-1 is making new lows. Investors who want exposure to that theme are buying Palo Alto Networks or Lockheed Martin. They are not buying a loss-making software company. This proves that the idiosyncratic risk, the bad balance sheet, the management turnover, outweighs the thematic tailwinds. The market is saying, we know war is coming, and we still don't want this stock.
I'm not convinced by that line of reasoning because it assumes the market is rational in the short term. I argue this decoupling is temporary and represents a massive mispricing. The market is treating Sentinel-1 as a risk-off asset because of the unprofitability, completely ignoring its utility in a cyber warfare environment. When the actual spend from these geopolitical tensions hits the income statement, when governments and enterprises start panic buying coverage, the stock will catch up. The disconnect between the threat level and the stock price is the opportunity. It's arbitrage.
Or it proves that in a serious geopolitical crisis, nobody wants a best-of-breed point solution. They want the platform standard. They want IBM. They want Palo Alto. They don't want a vendor who might run out of cash. But let's bring this to a close. For me, SentinelOne is a show-me story and a tell-me market. Until the CFO transition is settled and until they resolve this profitability paradox by narrowing those gap losses, this stock is dead money. The breakdown of the 1380 support level is terrifying. If that breaks, algorithmic selling is going to push this into uncharted territory. Single digits aren't impossible.
And I see the exact opposite potential. The risk-reward at 1390 is asymmetric. You have a company with $1.1 billion in cash, trading at 4.5 times revenue, growing at 23%. If the public market doesn't want it, private equity will. Thoma Bravo or Vista would look at these cash flows and that customer base and take it private in a heartbeat. The downside is capped by that takeover appeal. And that 67% dark pool short position, that is fuel. The market has gone too far in punishing a company that is still fundamentally growing. I believe we are at the bottom.
Well, we won't have to wait long to find out. We both agree that the Q4 earnings print in March 2026 is the binary event that settles this.
Absolutely. March will be the deciding factor.
Until then, tread carefully.
And keep looking at the data.
If you like this video and want to watch more content like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching. See ya.